Most people think commercial real estate boomed in the 2010s because of low interest rates. And yeah, rates were at historic lows, but that's not the whole story. In fact, it's not even the most important part.
News in-depth coverage now on the growing financial crisis. Yesterday, the House rejected the $700 billion bailout plan, sending shockwaves through Wall Street. The bailout plan was voted down 228 to 205. The Dow plunged to a record low yesterday, reaching 777 points and closing the day at 10,365. And that is the largest single-day point loss ever.
Coming out of the Great Recession, the Fed kept rates near zero. That helped restart lending, made debt cheap, and got the market moving again. But low rates alone don't drive valuations. Let's break down what actually drove the surge in commercial real estate values during that decade and why it was about a lot more than just interest rates.
Richard Bernstein is vice chairman of Cassidy Turley, one of the nation's largest commercial real estate services firms, and he joins us now with his perspective. Richard, welcome to the show. Thanks for joining us. Let me ask you, first of all, about where we are in the cycle here. I mean, do you see commercial real estate bottoming out? Are we still a year away from that? What does it look like?
First, after the Great Recession, the economy slowly stabilized and began to grow. Businesses recovered, consumer confidence returned, and demand for space came back, especially in major metros. Vacancies dropped across office, industrial, and multifamily sectors. Rents climbed, and landlords gained pricing power. And as a result, NOI steadily increased year after year. And in commercial real estate, rising income equals rising value, especially when cap rates stay the same or go down. So while rates made borrowing easier, it was strong, consistent income growth that gave buyers real confidence in their upside. Number two, cap rates, they didn't just hold steady, they compressed across the board. Why? Because risk perception fell. The further we got from 2008, the more confident investors became. And to that, a flood of institutional and international capital chasing yield in a zero-rate world. And you had intense demand for core assets in stable markets. Buyers were willing to accept lower returns, which mathematically push values higher, even for the same stream of income. Think about it this way in real terms. That meant a property generating $1 million in net income might have sold for $12 million in 2010. But by 2017, that same NOI could be worth $16 to $18 million purely because the market accepted a lower cap rate. Number three, capital markets came roaring back. Life companies, debt funds, CMBS lenders, everyone wanted in the party.
You know what we gotta do? Toga party. Toga! Toga!
Financing was not only cheap, it was available again. Leverage returned to the market. Loan to values crept up. Interest-only structures became common again. And that additional leverage allowed investors to pay more. It allowed them to juice returns and get more aggressive on pricing.
Excuse me, how much is this?
$1.19.
I'll give you a quarter.
Get the hell out of here.
The market wasn't just functioning at that time, it was booming. Number four, then there was psychology, and it played a massive role. As the stock market hit new highs and the fear of 2008 faded, confidence returned in full force. Everyone from REITs to sovereign wealth funds wanted exposure to U.S. commercial real estate. Capital poured in from Europe, Asia, and the Middle East, looking for yield, safety, and dollar-dominated assets. That global demand created bidding wars, pushing up asset prices and keeping cap rates low, especially in core gateway markets like New York, LA, San Francisco, and Washington, D.C. This wasn't just a recovery, it was a full-blown hunt for yield in a world where most other safe investments were paying next to nothing. So what's the takeaway? Low interest rates opened the door, but it was rising fundamentals, renewed confidence, and global capital that walked right on through it. Cheap money lit the match, but income growth and investor sentiment are what made it a full-on bull market. What did we learn? Don't mistake fuel for fire. Interest rates matter, but the real drivers of value are income, confidence, and capital flow. If this gave you a new perspective, hit the subscribe button and let's keep going.